Every financial news outlet covering the Federal Reserve right now is asking the same question. Is Kevin Warsh a hawk or a dove? Will he cut rates? Will he fight Trump? These are the wrong questions, and the people asking them are about to be blindsided by what is actually happening. They're all focused on the weather when a tectonic plate is shifting right under their feet. You see, the real story here is not about interest rates. It's about whether the Federal Reserve, as an institution, is about to be fundamentally rebuilt from the ground up. Right now, every investor is positioning for a pretty simple, dovish Fed pivot, right? Lower short rates, stocks go up, bonds rally at the front end. But if you actually read what Kevin Warsh has been saying for the past 15 years, and if you look at what the Trump administration has actually done, instead of just what it said, well, the trade that most people are setting up for might be precisely exactly wrong. The real implications here are structural, not cyclical, and the market is almost completely unprepared for it. So stick with me here, because this next part really matters. By the end of this explainer, you're going to understand how the Fed went from being a narrow lender of last resort to, well, arguably the most powerful unelected institution on Earth. You'll see exactly why all those political attacks aren't really about rate cuts. You'll know what Warsh's 15-year reform agenda actually is, and most importantly, what 4 specific market implications could follow if this real agenda actually moves forward. All right, Section 1, the Fed that swallowed America. To really get where this is all going, you first have to grasp what the Federal Reserve has become. So, when Congress first created the Fed back in 1913, it was designed to be a plumber. Its job was really narrow: prevent bank runs, keep prices stable, and maintain a modest balance sheet. That's it. Simple. But today's Fed, it's a completely different animal. It's holding a $6.7 trillion balance sheet. It's trying to manage the entire economic cycle, and it acts as the single most dominant regulatory force in finance. The plumber who was just supposed to fix leaks in an emergency has somehow become the architect of the entire building. And the path to this empire, it has some really clear signposts. It all starts in 2008, when quantitative easing, or QE, began as a genuine emergency tool to save the banking system. But the pivotal moment, the real crossing of the Rubicon, was in November 2010. That's when QE2 was launched. For the very first time, the Fed expanded its balance sheet not to stop a financial collapse, but just as a routine stimulus tool. The emergency measure became the new normal. And it was at that exact meeting that Kevin Warsh voted against it on principle, before resigning just a few months later. What came next was a whole decade of escalating intervention, from the taper tantrum in 2013, when markets freaked out at the mere hint of less stimulus, all the way to 2021, when the Fed was buying $120 billion in assets every single month while telling us all that inflation was transitory. And this chart just brilliantly illustrates the sheer scale of that shift. Just look at this. Before the crisis in 2007, the balance sheet was less than $1 trillion. It peaked at nearly $9 trillion. Even today, it's a staggering $6.7 trillion. Each of these jumps represents a deeper and deeper entanglement with the market, a further departure from that original mission. This isn't just a bigger number you see, it's a fundamentally different institution. But here is what nobody's really talking about. This massive expansion was driven by this deep, almost religious belief in economic models. And at every single critical juncture, those models have failed spectacularly. They didn't see the housing crisis coming. They didn't predict the failure of QE to generate any inflation for a decade. And they certainly didn't see the intensity of the inflation that finally showed up. The dot plot, the Fed's own forecast of where its members think rates are going to go, is probably the most famous symbol of this failure. In 2021, it showed basically no rate hikes through 2023. We all know how that turned out. The crucial point here is these forecasts weren't just a little bit off, they were directionally wrong. Okay, now this is where it gets really interesting, and you need to understand this part to get the whole picture. The Fed's power isn't just about printing money, it's about regulation. You see, post-crisis rules, specifically a package called Basel III, created this hidden trap. Here's how it works. First, a rule called the liquidity coverage ratio forces banks to hold tons of super safe assets, like Fed reserves or treasuries. Then, another rule makes holding government debt look completely risk-free, which encourages them to buy even more. But then a third rule, the leverage ratio, limits their total assets, no matter how risky they are. You see the trap? The rules create this massive artificial demand for government debt and Fed reserves, which then forces the Fed to keep its balance sheet enormous just to supply the system. It's a subtle form of financial repression, using regulation to create a permanent, captive buyer for government debt. Okay, Section 2, Decoding Trump's Target. This brings us right to the politics. The market has a very simple, very neat story about what a Trump-appointed Fed chair would do. But that story is built on sand. Just think about it for a second. If all you wanted were rate cuts, why would you publicly humiliate the chairman of an independent central bank? It's probably the single worst way to get what you want. Any Fed chair who caves to that kind of pressure immediately destroys their own credibility and the institutions along with it. The fact that he keeps doing it tells you the attacks are serving a completely different purpose. What the market hears as a literal demand for rate cuts is really just political stagecraft. So when he yells, "Cut rates now," the strategic goal is to pull the media's focus back to any data showing inflation has fallen. When he says Powell is failing, he's pre-establishing a scapegoat for any future recession. And shouting, "The Fed is the enemy," that resonates perfectly with his anti-establishment voter base. It's all a calculated performance, not an actual policy directive.
So, what is the real agenda? Well, the administration has actually stated it pretty clearly, but almost no one seems to be listening. They want to substantially reduce the Fed's balance sheet. They want to empower the regional Fed banks to connect with the real economy, not just with Wall Street. They want to return the Fed to its core mandate of price stability and strip away all its newer roles in social policy. Now, here's the thing. These goals are the exact opposite of dovish. They are classically hawkish, but they align perfectly with a voter base that deeply distrusts government intervention and wants to see Washington's power weaken.
Which brings us to Section 3, Warsh's Reconstruction. This is precisely why Kevin Warsh was chosen. He's not just some candidate. He is the architect of the very Reconstruction plan the administration wants to execute. See, to execute a reform this radical, you need someone who knows the institution from the inside out, but also has the intellectual independence to actually dismantle parts of it. Warsh served as a governor, he resigned on principle, and he has spent the last 15 years building the public framework for this exact agenda. His long, very consistent public record isn't a liability, it's his credibility armor against any accusations that he's just a political puppet.
And his entire plan is built on 4 philosophical pillars that are really a direct rebuke of the last 2 decades of Fed policy. First, humility. Just admit that you cannot precisely model a complex global economy. Second, fidelity. Stick only to the job Congress gave you, not climate risk or social equity. Third, provide a clear framework for your decisions, not a series of failed forecasts like the dot plot. And fourth, accountability. When you make a huge mistake, like calling inflation transitory, you own it, because that's how you build real, lasting trust.
So how do these pillars translate into a specific blueprint? Well, the most immediate change would be an aggressive acceleration of quantitative tightening to shrink that massive balance sheet. At the same time, a Warsh Fed would recalibrate those Basel III regulations we talked about to free up bank lending. He'd pursue a new Fed Treasury Accord to coordinate this whole process, and he'd overhaul communication entirely, likely by getting rid of the dot plot and ending the practice of detailed forward guidance. Now, let's talk about that Fed Treasury Accord for a second. Everyone hears that phrase and immediately thinks it means the Treasury will just tell the Fed what to do. But that gets the history completely backwards. The original 1951 Accord was actually created to free the Fed from being forced to finance government debt at low rates. Warsh's argument is that QE has put the Fed right back in that same trap. So a new accord isn't about subordination at all. It's about a coordinated escape plan to restore the Fed's independence from the government's borrowing needs. Section 4, New Market Realities. All right, so if this is the real agenda, what does it actually mean for markets? Let's walk through 4 consequences that are very, very different from the consensus view. First up, you should expect a bear steepening of the yield curve. As the Fed aggressively accelerates its balance sheet reduction, it stops being the biggest buyer of long-term government bonds. That supply hits the market, and that pushes long-term rates higher. Meanwhile, short-term rates might stay stable or even fall a little bit as the tightening is being done through the balance sheet, not the main policy rate. The result? A steeper curve. Second, and this is a really big one, is a higher neutral rate for the entire economy. You can think of the neutral rate as the economy's underlying cruising speed, the interest rate that keeps things stable without overheating or slowing down. As those Basel III regulations are recalibrated, bank balance sheets are freed up. That unleashes more credit and lending to the real economy, which drives investment and capital expenditures. And higher investment demand means the economy's cruising speed. Its structural interest rate has to be higher. The entire curve has to reprice upward over time. And the third implication follows directly from that last point. Who benefits the most from freer bank lending? It's not the mega-cap tech companies who can tap capital markets whenever they want. No, it's the small and mid-sized industrial companies, the ones financed by regional banks. So as credit conditions improve for them, you should expect to see that massive valuation gap between something like the Russell 2000 and the NASDAQ 100 finally start to close.
And finally, there's a fascinating, kind of contrarian possibility. If Warsh actually pulls this off, if he establishes true anti-inflation credibility, the market might just reward him for it. If investors really believe the Fed will crush inflation no matter what, they won't demand as much of a risk premium on long-term bonds. So, as short-term rates rise to fight inflation, long-term rates could actually fall, or at least rise less. This is called a bear flattening, and it's the ultimate sign that the market truly trusts the central bank. Now, Section 5, the risks and the edge. Look, this is a massive, ambitious undertaking, and it would be foolish to ignore the risks. There are some very significant hurdles to this plan. First, the execution complexity is just off the charts. Trying to shrink the balance sheet while simultaneously recalibrating financial regulations is like trying to rewire a plane while it's in the air. One misstep could trigger a serious market dislocation. Second, the institutional resistance is going to be immense. The Fed's own bureaucracy, academic economists, and the parts of Wall Street that benefit from the current system will fight this at every single turn. And finally, there's a perception issue. Warsh is a lawyer, not a PhD economist, and while that didn't stop a titan like Paul Volcker, it's a perceived risk that the market will not ignore. Markets reward the people who do the work before the crowd shows up. You just did the work. See you in the next one.